Question 1. Which of the following is not typically a key player in the reinsurance process? A. Ceding insurer. B. Reinsurer. C. Broker. D. Risk analyst. Answer D. Risk analyst. Explanation. In the reinsurance process, the key players typically include ceding insurer, the original insurer who transfers risk to the reinsurer, or reinsurer, the company that assumes the risk from the ceding insurer. Broker, a professional who facilitates the transaction between the ceding insurer and the reinsurer. A risk analyst, while important in assessing risk, is not one of the primary entities in the reinsurance process. Thus, the correct answer is D. Question 2. Scenario-based. Mr. Anderson works as an underwriter for an insurance company in Mississippi. He is reviewing a reinsurance treaty for a catastrophic risk involving hurricanes. The treaty contains an excessive loss agreement. Mr. Anderson is unsure about how the excessive loss coverage will apply in a situation where claims exceed the agreed threshold. What should Mr. Anderson consider in order to properly assess the treaty's terms? A. The reinsurer's obligation is triggered when claims exceed the excess amount and the ceding insurer retains responsibility for all losses below the threshold. B. The reinsurer will pay for all losses up to a specified amount, with the ceding insurer covering the remainder. C. The reinsurer only covers claims that exceed a certain threshold, and any losses below the amount are the responsibility of the ceding insurer. D. The reinsurer will cover all claims regardless of the amount, as long as the event qualifies as a catastrophe. Answer C. The reinsurer only covers claims that exceed a certain threshold, and any losses below that amount are the responsibility of the ceding insurer. Explanation. An excessive loss reinsurance agreement is a form of non-proportional reinsurance. Under this arrangement, the reinsurer's liability is triggered when the losses exceed a certain threshold, the retention limit set in the treaty. The ceding insurer is responsible for any losses up to this threshold, and the reinsurer only covers the excess. Option C accurately describes this arrangement. Option is incorrect because it suggests that the reinsurer covers all losses above the threshold, but it fails to account for the fact that the ceding insurer retains responsibility for losses below the threshold. Option B misrepresents the excessive loss structure, as the reinsurer does not pay for all losses, but only those exceeding the specified amount. Option D incorrectly suggests that the reinsurer will cover all claims, which is not true in an excessive loss arrangement. Question 3. Which of the following best describes the concept of a quota share in proportional reinsurance? A. The ceding insurer retains a fixed percentage of the risk, while the reinsurer assumes a fixed percentage of both the risk and the premium. B. The reinsurer assumes all risks above a certain threshold, leaving the ceding insurer to cover only smaller claims. C. The reinsurer retains a fixed percentage of the risk and premium, while the ceding insurer retains the remainder of both the risk and premium. D. The ceding insurer and reinsurer split risk equally, with each party retaining a set percentage of the risk and premium. Answer A. The ceding insurer retains a fixed percentage of the risk, while the reinsurer assumes a fixed percentage of both the risk and the premium. Explanation. In quota share reinsurance, the ceding insurer and the reinsurer agree to share both the risk and the premium on a fixed percentage basis. For example, in a 50% quota share agreement, the ceding insurer retains 50% of the risk and the corresponding premium, and the reinsurer assumes the other 50%. Option B describes a non-proportional reinsurance agreement, not quota share. Option C is incorrect because it reverses the roles of the ceding insurer and reinsurer, where the reinsurer retains a percentage of the risk and premium, not the ceding insurer. Option D also inaccurately implies an equal sharing of both the risk and premium, which can vary depending on the agreed terms in the quota share agreement. Question 4. Which of the following is a characteristic feature of treaty reinsurance? A. It is arranged on a case-by-case basis for each individual risk. B. It automatically covers all risks within the scope defined by the treaty without the need for individual negotiations. C. It applies only to catastrophic events such as natural disasters. D. It involves a single risk transfer rather than a portfolio of risks. Answer B. It automatically covers all risks within the scope defined by the treaty without the need for individual negotiations. Explanation. Treaty reinsurance is an agreement where the reinsurer agrees to cover her portfolio of risks or classes of business defined by the ceding insurer. Unlike facultative reinsurance, there is no need for individual negotiations for each risk. If the risk falls within the agreed treaty scope, automatically covered. Option It describes facultative reinsurance, which involves a case-by-case negotiation. Option C is inaccurate because treaty reinsurance is not limited to catastrophic events but can cover a wide range of risks. Option D misrepresents treaty reinsurance as it involves multiple risks rather than a single transfer. Question 5. In Mississippi, which of the following is a primary requirement for a reinsurer to be licensed by the Mississippi Department of Insurance? The reinsurer must maintain a best rating of A or higher. B. The reinsurer must be based in the United States and have a physical office in Mississippi. C. The reinsurer must provide a proof of solvency and meet capital adequacy requirements specified by the Mississippi Insurance Code. D. The reinsurer must enter into a reinsurance treaty with at least 3 local insurers in Mississippi. Answer: C. The reinsurer must provide a proof of solvency and meet capital adequacy requirements specified by the Mississippi Insurance Code. Explanation: in Mississippi, reinsurers seeking to operate in the state must meet specific regulatory requirements set by the Mississippi Department of Insurance, including providing proof of solvency and meeting capital adequacy standards. This ensures the financial stability of the reinsurer and its ability to fulfill reinsurance obligations. Option is incorrect because the requirement for an A.M. best rating is not specific to Mississippi's licensing process, although financial strength ratings are important. Option B is also inaccurate because while reinsurers need to meet solvency and financial standards, they do not need physical office in Mississippi. Option D is incorrect as there is no requirement to enter into specific treaties with local insurers for licensing. Question 6. Scenario-based. Mr. Rodriguez, a reinsurance broker, is negotiating a treaty reinsurance agreement for a large insurer in Mississippi. The treaty is designed to cover all claims from windstorm damage in coastal areas, but it contains a stop-loss provision. The reinsurer will cover losses that exceed a specific threshold, but only up to a maximum limit. During a significant windstorm, the insurer experiences claims that exceed the agreed threshold. What should Mr. Rodriguez do to ensure the insurer gets the most comprehensive coverage? A. Mr. Rodriguez should advise the insurer to file a claim for all losses, including those below the threshold, as the reinsurer will pay for everything. B. Mr. Rodriguez should ensure that the insurer understands the maximum limit of the stop-loss provision and the reinsurer's obligation only applies beyond the threshold up to the limit. C. Mr. Rodriguez should negotiate for higher stop-loss limit, as the insurer will be responsible for any below the threshold. D. Mr. Rodriguez should recommend facultative reinsurance for the excess claims, as stop-loss agreement will not cover catastrophic events. Answer: B. Mr. Rodriguez should ensure that the insurer understands the maximum limit of the stop-loss provision and the reinsurer's obligation only applies beyond the threshold up to the limit. Explanation: in stop-loss reinsurance agreement, the reinsurer covers losses that exceed specified threshold retention, but only up to maximum limit. The insurer must understand this structure to ensure they are aware of the reinsurer's liability and the cap on potential recoveries. Option is incorrect because the reinsurer will not pay for losses below the threshold in stop-loss agreement. Option C, while it suggests negotiating higher limit, misses the fact that the reinsurer only covers losses exceeding the threshold. Option D is inaccurate because facultative reinsurance would not be the appropriate solution for claims under stop-loss agreement. Question 7. Which of the following is a key benefit of non-proportional reinsurance agreements like excessive loss? A. The reinsurer assumes a fixed percentage of both the risk and premium regardless of loss size. B. The ceding insurer retains responsibility for all losses and the reinsurer only covers those above the deductible. C. The reinsurer assumes all claims for losses under a fixed threshold. D. The ceding insurer is not responsible for losses above the agreed retention amount and the reinsurer covers any excess claims. Answer: D. The ceding insurer is not responsible for losses above the agreed retention amount and the reinsurer covers any excess claims. Explanation: in non-proportional reinsurance, such as excessive loss, the reinsurer covers only the claims that exceed the retention amount threshold. The ceding insurer retains responsibility for claims below this threshold, but any losses above it are transferred to the reinsurer. Option: it describes proportional reinsurance rather than non-proportional reinsurance. Option B is inaccurate because the reinsurer only covers claims above the agreed threshold, not the losses under the deductible. Option C is incorrect, as the reinsurer does not assume all claims under a threshold in excess of loss agreements. Question 8. Which of the following is the main purpose of solvency regulations in reinsurance? A. To ensure reinsurers are able to pay claims promptly and remain financially stable. B. To provide tax benefits to reinsurers operating in multiple jurisdictions. C. To limit the number of treaties that can be written by a reinsurer. D. To dictate the amount of premium a reinsurer must charge for a policy. Answer A. To ensure reinsurers are able to pay claims promptly and remain financially stable. Explanation. Solvency regulations are designed to ensure that reinsurers have the necessary financial resources to meet their obligations and pay claims as they arise. These regulations set minimum capital requirements, risk-based capital standards, and other criteria to maintain the financial health of reinsurers. Option B is incorrect because solvency regulations are focused on financial stability rather than providing tax benefits. Option C is not correct because solvency regulations do not directly limit the number of treaties a reinsurer can write. Option D is inaccurate since solvency regulations focus on capital adequacy and financial health, not the pricing of policies. Question 9. When calculating the ceding commission in a proportional reinsurance agreement, which of the following factors is most likely to influence the amount of commission paid to the ceding insurer? A. The reinsurer's investment return rate. B. The amount of premium paid to the reinsurer. C. The volume of business ceded and the profit-loss experience. D. The risk retention level agreed upon in the treaty. Answer. C. The volume of business ceded and the profit-loss experience. Explanation. The ceding commission is generally calculated based on the volume of business ceded to the reinsurer and the profit-loss experience from the reinsurance agreement. If the reinsurer is making a profit from the treaty, the commission will reflect that performance. Option A, while investment returns impact reinsurer profits, does not directly affect the ceding commission calculation. Option B is relevant to the premium, but the commission is more directly tied to ceded volume and profitability. Option D relates to risk retention, but does not directly determine the amount of ceding commission, which is influenced more by the volume and profitability. Question 10. Which of the following best describes the facultative reinsurance agreement? A. It automatically covers all risks under a treaty without the need for individual approval. B. The ceding insurer submits individual risks for approval, with each risk negotiated separately. C. It is designed to cover only catastrophic risks, such as earthquakes or floods. D. It is the reinsurance form where the reinsurer takes on a fixed percentage of every risk from the ceding insurer. Answer. B. The ceding insurer submits individual risks for approval, with each risk negotiated separately. Explanation. Facultative reinsurance is negotiated on a case-by-case basis. The ceding insurer submits individual risks for the reinsurer's approval, and both parties agree to the terms for each specific risk. Question 11. Which of the following is an advantage of using quota share reinsurance? A. The reinsurer covers only the losses exceeding a certain threshold. B. The ceding insurer retains a higher proportion of the premium but assumes more risk. C. The ceding insurer and reinsurer share a fixed percentage of both premiums and claims. D. The reinsurer assumes the entire risk for all claims under the agreement. Answer. C. The ceding insurer and reinsurer share a fixed percentage of both premiums and claims. Explanation. In quota share reinsurance, the reinsurer assumes a fixed percentage of both premiums and claims. This allows for a more equitable distribution of risk and helps stabilize the ceding insurer's financial position. Question 12. In the event of a catastrophic event, which type of reinsurance would most likely be invoked? A. Facultative reinsurance. B. Quota share reinsurance. C. Excessive loss reinsurance. D. Proportional reinsurance. Answer. C. Excessive loss reinsurance. Explanation. Excessive loss reinsurance is designed to protect against large, unexpected losses, such as those from catastrophic events. The reinsurer covers losses above the retention limit, making it a preferred option for catastrophic scenarios. Question 13. Which of the following statements is true regarding surplus share reinsurance? A. The reinsurer shares a fixed percentage of the total premium and losses regardless of the risk amount. B. The ceding insurer retains a fixed amount of risk and the reinsurer assumes any excess. C. The reinsurer only takes on specific high-value risks above a predetermined threshold. D. It is only applicable to specific perils, such as windstorms or earthquakes. Answer B. The ceding insurer retains a fixed amount of risk, and the reinsurer assumes any excess. Explanation: in surplus share reinsurance, the ceding insurer retains a fixed portion of each risk up to a specified amount, while the reinsurer covers the excess portion of the risk. This approach is typically used when risks exceed certain thresholds. Question 14. A reinsurer agrees to cover losses above $2 million, but only up to $10 million. What type of reinsurance agreement is this? A. Quota share. B. Excessive loss. C. Facultative reinsurance. D. Surplus share. Answer B. Excessive loss. Explanation: in an excessive loss reinsurance agreement, the reinsurer covers losses that exceed the retention limit, in this case $2 million, but only up to the maximum agreed upon amount, here $10 million. This is a non-proportional form of reinsurance. Question 15. Which of the following is a major benefit of ceding commissions in proportional reinsurance agreements? A. The ceding insurer receives a percentage of the premium for taking on some of the reinsurer's risk. B. The reinsurer receives a fixed payment for assuming a share of the ceding insurer's risk. C. The ceding insurer receives compensation to cover operational costs related to underwriting and administering policies. D. The reinsurer compensates the ceding insurer for retaining some risk in case of large losses. Answer C. The ceding insurer receives compensation to cover operational costs related to underwriting and administering policies. Explanation: ceding commissions are paid to the ceding insurer by the reinsurer in proportion to the premiums ceded. The purpose of these commissions is to reimburse the ceding insurer for the costs of underwriting and policy administration. Question 16. Which type of reinsurance is most likely to involve the reinsurer assuming part of the underwriting risk of the ceding insurer? A. Stop-loss reinsurance. B. Facultative reinsurance. C. Proportional reinsurance. D. Excessive loss reinsurance. Correct answer C. Proportional reinsurance. Explanation: in proportional reinsurance, the reinsurer shares both the premium and the underwriting risk with the ceding insurer. This can be done through either quota share or surplus share agreements. Question 17. Scenario-based reinsurance agreement includes a provision where the reinsurer will cover the losses exceeding $5 million up to a total of $15 million. The ceding insurer's retention limit is $5 million. In the event of loss amounting to $12 million, how much will the reinsurer pay? A. $5 million. B. $7 million. C. $12 million. D. $15 million. Answer B. $7 million. Explanation: under the excessive loss reinsurance agreement, the reinsurer covers losses exceeding the ceding insurer's retention limit. Since the retention limit is $5 million and the total loss is $12 million, the reinsurer will cover the excessive $7 million, i.e. $12 million. $5 million. Question 18. Which of the following is a primary regulatory concern for reinsurers operating internationally? A. The stability and solvency of the reinsurance market in the reinsurer's home country. B. The reinsurer's ability to diversify its portfolio of risks across countries. C. Ensuring the reinsurer meets local licensing and capital requirements in each jurisdiction. D. The global tax rates applied to reinsurance transactions. Answer C. Ensuring the reinsurer meets local licensing and capital requirements in each jurisdiction. Explanation: reinsurers operating internationally must adhere to the regulatory requirements of each country in which they operate. This includes meeting local licensing, solvency, and capital adequacy requirements to ensure they are financially stable and able to meet their obligations. Question 19. In a treaty reinsurance agreement, who typically negotiates the terms? A. The ceding insurer and the reinsurer for each individual risk. B. The ceding insurer and reinsurer on a blanket basis for all risks covered under the treaty. C. A reinsurance broker on behalf of both parties. D. A regulatory body acting as a mediator between the two parties. Answer B. The ceding insurer and reinsurer on a blanket basis for all risks covered under the treaty. Explanation: in treaty reinsurance, the ceding insurer and reinsurer agree on broad terms that apply to all risks covered under the treaty. This means that the reinsurer covers all risks within the scope of the treaty without individual negotiations for each risk. Question 20. What is the purpose of a retrocession in reinsurance? A. To transfer risk from the primary insurer to the reinsurer. B. To transfer risk from one reinsurer to another. C. To allocate a fixed percentage of premiums to the ceding insurer. D. To reduce the exposure of a reinsurer by transferring part of its liability to another reinsurer. Answer D. To reduce the exposure of a reinsurer by transferring part of its liability to another reinsurer. Explanation. A retrocession is the transfer of risk from one reinsurer to another. Reinsurers may use retrocession to reduce their exposure by sharing part of the risk with another reinsurer. Question 21. Which of the following best describes the difference between proportional and non-proportional reinsurance? A. In proportional reinsurance, the reinsurer covers all claims, while in non-proportional, the ceding insurer covers all claims. B. In proportional reinsurance, the reinsurer covers a fixed percentage of claims, while in non-proportional, they only cover losses above a certain threshold. C. Proportional reinsurance applies to specific high-risk perils, while non-proportional applies to all risks. D. Non-proportional reinsurance shares premiums and claims equally, while proportional reinsurance does not. Answer B. In proportional reinsurance, the reinsurer covers a fixed percentage of claims, while in non-proportional, they only cover losses above a certain threshold. Explanation. In proportional reinsurance, the reinsurer shares both premiums and claims in a fixed ratio. In non-proportional reinsurance, the reinsurer covers only losses that exceed a certain amount or threshold, e.g. in excessive loss agreements. Question 22. Which of the following is a primary responsibility of the ceding insurer in a reinsurance agreement? A. To assume a share of the losses from the reinsurer. B. To pay the entire premium to the reinsurer. C. To pay the agreed upon retention amount for losses. D. To ensure the reinsurer maintains sufficient capital reserves. Answer C. To pay the agreed upon retention amount for losses. Explanation. The ceding insurer is responsible for retaining a portion of the risk, the retention amount, which they will cover in the event of a claim. The reinsurer assumes the excess risk above that retention. Question 23. What is the typical role of a reinsurance broker in a reinsurance agreement? A. To act as the intermediary between the ceding insurer and the reinsurer. B. To provide capital to the reinsurer in case of catastrophic losses. C. To directly assume risks from the ceding insurer. D. To ensure the reinsurer complies with all local regulations. Answer A. To act as the intermediary between the ceding insurer and the reinsurer. Explanation. A reinsurance broker acts as an intermediary facilitating negotiations between the ceding insurer and the reinsurer. They help both parties find mutually agreeable terms and assist in placing reinsurance contracts. Question 24. In the event of a claim under an excessive loss reinsurance agreement, which of the following will the reinsurer pay? A fixed percentage of the total loss amount. B. The full amount of the loss exceeding the retention limit. C. A fixed amount per claim, regardless of the loss severity. D. Only a portion of the loss up to a predetermined percentage. Answer B. The full amount of the loss exceeding the retention limit. Explanation. Under excessive loss reinsurance, the reinsurer covers all losses that exceed the ceding insurer's retention limit up to the agreed upon maximum amount. Question 25. Which type of reinsurance agreement allows the ceding insurer to transfer a large portion of its risk to the reinsurer, typically covering high-value individual risks? A. Facultative reinsurance. B. Excessive loss reinsurance. C. Quota share reinsurance. D. Stop-loss reinsurance. Answer A. Facultative reinsurance. Explanation. Facultative reinsurance allows the ceding insurer to transfer large individual risks to the reinsurer on a case-by-case basis. This reinsurance type is used for high-value or unusual risks that are not automatically covered under a treaty. Question 26. Which of the following is a key advantage of stop-loss reinsurance for the ceding insurer? A. It provides coverage for catastrophic losses exceeding a certain threshold. B. It helps limit the total amount of losses a ceding insurer can bear during a specific period. C. It covers a fixed percentage of every individual loss. D. It guarantees a minimum return on premiums paid by the ceding insurer. Answer B. It helps limit the total amount of losses a ceding insurer can bear during a specific period. Explanation. Stop-loss reinsurance provides the ceding insurer with coverage for aggregate losses over a defined period, e.g. a year. If the ceding insurer's losses exceed predetermined threshold, the reinsurer will cover the excess, thereby limiting the insurer's total exposure. Question 27. Scenario-based, a reinsurer has agreed to cover losses exceeding $10 million up to a maximum of $50 million. In the event of a loss amounting to $60 million, how much will the reinsurer pay under the terms of this agreement? A. $40 million, B. $50 million, C. $60 million, D. $10 million. Answer: B. $50 million. Explanation: the reinsurer covers losses that exceed the ceding insurer's retention limit of $10 million up to maximum of $50 million. Since the total loss is $60 million, the reinsurer will pay $50 million, which is the maximum amount covered under the agreement. Question 20. Which of the following reinsurance agreements would be most suitable for an insurer seeking protection against high-frequency, low-severity claims? A. Excessive loss reinsurance. B. Stop-loss reinsurance. C. Facultative reinsurance. D. Quota-share reinsurance. Answer: D. Quota-share reinsurance. Explanation: quota-share reinsurance is ideal for situations where the insurer wants to share a fixed percentage of both premiums and claims, making it suitable for high-frequency, low-severity claims. This helps the ceding insurer spread its risk more evenly. Question 29. In non-proportional reinsurance, the reinsurer typically only covers losses above which of the following? A. The ceding insurer's retention limit. B. The total premium paid by the ceding insurer. C. Fixed percentage of the total risk. D. The policyholder's deductible. Answer: A. The ceding insurer's retention limit. Explanation: in non-proportional reinsurance, the reinsurer covers losses that exceed the ceding insurer's retention limit, usually after a certain threshold of loss is reached, rather than sharing percentage of all risks. Question 30. Which of the following is a key regulatory concern for reinsurers in terms of solvency? A. Reinsurers must maintain reserves sufficient to cover future claims. B. Reinsurers must diversify their portfolio to include only low-risk policies. C. Reinsurers are not required to hold capital reserves if they operate internationally. D. Reinsurers are only required to cover their own operational costs and not future claims. Answer: A. Reinsurers must maintain reserves sufficient to cover future claims. Explanation: regulatory authorities require reinsurers to maintain adequate reserves to ensure they can meet future claims and policyholder obligations. This is crucial for maintaining the financial stability of the reinsurance market.